Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica.
And my name is Guy. Here are the top stories in crypto this week.
Sell the news. BTC tumbles despite the recent spot ETF approvals and continued inflows. Why is the crypto market looking so weak?
ETH blasting off. Transactions on Ethereum hit a multi-year high, while a controversial Layer 2 launches its testnet and a developer report reveals the EVM's supremacy. What does this mean for ETH?
SEC versus Coinbase. The crypto industry speculates about the possibility that the SEC's case against Coinbase will be thrown out following a meeting with the judge. Everything you need to know.
Red Sea concerns. Disruption to a major supply chain lead to concerns that inflation could come back in a big way. How it could affect the crypto market.
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment. Last week, the crypto market experienced an unexpected downturn led by BTC. The downturn is believed to have been due to the over $5 billion of outflows coming from Grayscale's spot Bitcoin ETF, as GBTC arbitrageurs took their long-anticipated profits. The practical effect of this was BTC selling. There's just one problem with this perspective, and that's that the inflows into the other spot Bitcoin ETFs exceeded the outflows from Grayscale's by billions of dollars. Logically, this should have caused BTC's price to rise, not fall. However, this assumes that GBTC arbitrageurs are the only sellers in this equation. Bloomberg ETF analyst Eric Balchunas revealed in a recent interview that the selling pressure following the spot Bitcoin ETFs appears to have come from BTC whales. This is consistent with what can be seen on whale transaction trackers like Whale Alert, where billions of dollars of BTC are being sent to exchanges. Meanwhile, on Wall Street, the interest in BTC and crypto reportedly continues to grow. The only reason this hasn't translated to more inflows into the spot Bitcoin ETFs yet is because it takes time for asset managers and investment advisors to do due diligence on new ETFs and then offer them to clients. In other words, there will likely come a point where the inflows from TradFi investors will exceed the outflows from GBTC and the selling pressure from BTC whales. This will likely occur regardless, since all the GBTC holders and BTC whales will eventually run out of assets to sell, all while TradFi keeps buying. In the short term, though, there's no question that this is dragging down BTC's price. As you can see, BTC is looking very weak on the daily chart. It's sitting around a critical zone of resistance of roughly 42k and could crash down to 38k in the coming days. Note that long liquidations could take BTC lower. Zooming out to the weekly suggests that BTC could fall as low as 35k. You'll notice that this is where the Bollinger Band moving average is on this time frame, and that it has been very accurate at noting when BTC is in a bull phase or a bear phase. So long as BTC is above this level, the bull continues. Alternatively, BTC could bounce from this level and retest the Bollinger Band moving average from below, a move to roughly 44k. Depending on the catalyst which causes this move, it's possible that BTC will break back above that key level into bullish territory. Note that a short squeeze could occur too. In this case, the largest could be a retest of the recent high of roughly 49k. But make no mistake, this would require a very bullish catalyst of some kind. We'll come back to one such catalyst later on. Now, if you're planning to trade what is likely to be an explosive move, then be sure to check out the Coin Bureau deals page. It's got trading fee discounts of up to 60% and bonuses of up to $50,000 on the best crypto exchanges. These deals are the best out there and are only available here on Coin Bureau. It's for a limited time only, so check them out ASAP. The link will be in the description. Now, although the crypto market has been looking sluggish, if you peek below the surface, you'll notice something peculiar. ETH is looking surprisingly robust relative to BTC. For starters, ETH is still above the Bollinger Band moving average on the daily, meaning that it's still looking bullish in the short term. Not only that, but ETH has rallied significantly against BTC over the last couple of weeks and has maintained these recent gains despite the crypto market dip. In previous instances of such rallies, ETH would immediately lose ground to BTC when the crypto market fell. This time is different. Put simply, it looks like the rotation into ETH has finally begun, though it may not be obvious when the whole market is flashing red. This makes perfect sense, though, given that asset managers have turned their focus to the spot Ethereum ETFs in a big way. Franklin Templeton is the latest to call for an approval. While this is also nothing new, there is likewise something different happening beneath the surface. Transactions on Ethereum are at their highest level since November 2021. To put things into perspective, November 2021 was the top of the last crypto bull market. It's safe to say that Ethereum hitting these transaction levels at this stage in the crypto cycle underscores just how much ETH could explode in the next few months. In fact, Coinbase says that ETH will have a breakout year due to the Dencun upgrade, whose first testnet recently experienced some issues. If you watched our recent Ethereum update, you'll know we actually predicted that Ethereum could experience additional technical gremlins. Fortunately, the Dencun issues only occurred on testnet, which is to be expected. That's why they have testnets, after all. Unfortunately, Ethereum could face additional challenges and risks in the near term. The elephant in the room here is Blast, the controversial Ethereum Layer 2 that's currently in development, which also launched its testnet last week. To bring you up to speed, Blast is a Layer 2 that's accumulated over $1.3 billion in assets, mostly ETH, which is being staked through Lido Finance. The reason why Blast has been so controversial is mainly because it managed to attract so much total value locked despite not having developed anything, allegedly. To add insult to injury, it was only after a few weeks that the Layer 2 announced on Twitter/X that it had begun hiring developers. Anyway, controversies aside, the biggest concern about Blast is the massive amount of Lido-staked ETH that it has accumulated. Were there to be any issues with Blast, such as an exploit or otherwise, this could cause issues for STETH, which could in turn cause issues for Ethereum's DeFi ecosystem and ETH's price. Funnily enough, Blast recently announced its Big Bang competition, which aims to incentivize dApp developers to deploy on its Layer 2 before its launch sometime in late February. It's going to be interesting to see which devs and dApps take Blast up on its offer in the coming weeks. It seems likely that there will be at least a few who do. That's because Electric Capital's recent developer report revealed that 9 out of 10 multi-chain developers work with EVM-compatible blockchains. This highlights just how dominant Ethereum has become in the broader crypto ecosystem. And more importantly, it sets the stage for a scenario where Ethereum and its Layer 2s could take lots of market share away from other EVM chains that were being treated as de facto Layer 2s during the last cycle. Put differently, Ethereum could cement its dominance among smart contract cryptocurrencies. And by the way, if you're enjoying the video so far, be sure to smash that like button to give it a boost. Now, there is one big caveat though, and that's that Ethereum's competitors could soon experience an unprecedented boost. As some of you may have heard, the SEC and Coinbase went to court recently to argue whether the case they're embroiled in should be dismissed, an argument that apparently lasted for almost 5 hours. If you watched our video about the SEC's lawsuit against Coinbase, you'll know that the regulator alleges that some of the cryptos on Coinbase are unregistered securities. It also alleges that Coinbase's staking services constitute unregistered securities offerings. Now, if you watched our video about the ruling in the SEC's case against Ripple, however, you'll know that the judge there ruled that secondary sales of XRP on crypto exchanges do not constitute unregistered securities offerings. This is the main reason why many believe that the SEC's case against Coinbase will be thrown out. But, as I just mentioned, that's just one part of why the SEC sued Coinbase in the first place. There's also the staking services aspect, and this is where Coinbase could face more hurdles. That's because the SEC has precedents of its own. Kraken settled with the SEC over its staking services early last year. Of course, the specifics of Kraken's staking services and Coinbase's staking services are different, but it seems they're still similar enough that they could prevent Coinbase from getting off the hook. This was explained by attorney Sam Enzer in a recent interview with Laura Shin, which is well worth a listen if you have the time. So, this begs the question of when the judge will decide whether to throw out the SEC's case against Coinbase or not. Sam believes that this will happen by the end of Q1, so by the end of March. The bigger question, though, is whether she will decide to throw out the whole case or just parts of it, and this isn't clear yet. Regardless, the judge's decision will likely have a profound impact on the crypto market and the crypto industry. Take a second to consider that if the judge does throw out the case, or even just the part about certain cryptos being securities, this means that the altcoins the SEC is after will be off the hook. Obviously, this would be extremely bullish for all the altcoins that the SEC has claimed are securities, including those in the SEC's lawsuit against Binance. That's just because the judge's decision could likewise be used as a precedent by Binance's lawyers to water down the SEC's allegations. Now, if you're wondering how this all relates to Ethereum, it's because most of the cryptos that the SEC has labelled as securities are so-called Ethereum killers. Throwing out the SEC's case against Coinbase would effectively eliminate the regulatory uncertainty around these cryptos and allow them to grow. And if you watched our recent Solana update, you'll know that institutional investors are reportedly obsessed with that particular crypto project. It stands to reason then that many have been hesitant to invest because of the regulatory uncertainty created by the SEC. Any clarity from the courts could, therefore, allow them to ape in. This would likely evolve into a new wave of investment into the broader altcoin ecosystem, given that secondary sales of every altcoin would theoretically be above board. But let's not get ahead of ourselves just yet. We know that the SEC has a habit of handing out surprises, and they're seldom of the good kind. On that note, there's been no shortage of surprises on the geopolitical stage, but I suppose that depends on whether or not you've been paying attention. If you haven't been, then here's the TLDR. The conflict in the Middle East appears to be escalating, and it looks like it's starting to affect supply chains. Ground zero in this regard has been the Red Sea, where Yemeni rebels, the Houthis, have been seemingly attacking ships at random in protest at the brutal conflict between Israel and Palestine, or so they claim. In response, the US and its allies have started sending in larger and larger forces to repel these attacks. Now, for context, around 12% of the world's trade passes through the Suez Canal, which lies at the opposite end of the Red Sea. Notably, the route through the Red Sea and the Suez Canal is critical for transporting goods from Asia to Europe and the UK. The only alternative is to go around the entire African continent. As many news outlets have reported, rerouting trade in this way runs the risk of increasing inflation around the world. With the situation in the Middle East only continuing to escalate, some shippers are opting to go the longer route due to the risks and insurance costs associated with the Red Sea passage. As most of you will know, any inflation arising from such supply chain disruptions could run the risk of central banks having to keep interest rates high or even raise them higher. This would do serious damage to risk assets such as crypto, which are currently pricing in lots of rate cuts in 2024. Now, the good news is that it's likely that the US and its allies will get the Red Sea situation under control sooner or later. The bad news is that this could risk creating an escalation elsewhere in the region, probably involving Iran. For reference, Iran backs the Houthi rebels, causing chaos in the Red Sea. Attacks on the Houthis by the US and its allies could cause Iran to do something in response. Now, those of you who are deep in the weeds on geopolitics know that one thing Iran could do is cause issues in the Strait of Hormuz, through which 20% of the world's oil is shipped. As it so happens, though, Iran seems to be occupied with another conflict that's magically emerged. In any case, it's easy to forget about the worrying geopolitical backdrop against which the markets exist. At any moment, there could be a flare-up of an existing conflict, a new conflict, or a new set of sanctions or trade restrictions that could mess things up. Thankfully, though, crypto seems to be largely immune to most of these kinds of catalysts. And, speaking of crypto, it's about time we looked at last week's top-performing altcoins. So, Jessica, take it away.
Thanks, Guy. Well, last week's top-performing cryptos were Ronin, Flare, Astar, PYTH Network, and Chiliz. Starting with Ronin, its Ron coin appears to have rallied on the news that a new game on Ethereum would be airdropping its native token to early users, and the news that the Ronin wallet has added support for Ethereum, Polygon, and the BNB chain. As you can see, Ron has been on a massive tear since October. It's up by more than 5x since that time, and appears to have painted a massive double bottom pattern. If it plays out, Ron could potentially see explosive growth over the coming weeks. This assumes that BTC will continue to behave. Next up, we have Flare Network, whose FLR coin appears to have pumped on the news that Google Cloud has become a validator on its Layer 1 blockchain. As you can see, FLR has likewise been in an uptrend since October, though it hasn't been nearly as strong. The catch is that FLR doesn't have much resistance between its current levels and around 2.7 cents. This could translate into some more gains in the short term if the catalyst can keep it going. As for Astar Network, it's not entirely clear why its ASTR coin rallied. We suspect that it has something to do with Ethereum's Dencun testnet, given that Astar announced that it would be launching a Layer 2 on Ethereum last September, thanks to a partnership with Polygon. The more you know. Now, this would make sense, given that Astar's price has been explosive since that September announcement. The chart looks similar to Ron's in the sense that it could be in the process of painting a double bottom that could foreshadow a massive game in the medium term. Just remember that nothing goes up only. When it comes to PYTH Network, its PYTH token appears to have pumped due to the speculation that PYTH stakers will be eligible for additional airdrops in the future. Note that we recently covered PYTH Network for our Coin Bureau Club members. You can find more details on the deals page. Now, as you can see, PYTH is currently pushing up against a critical zone of resistance. If it can get above this zone, then it could see new all-time highs in the medium term. Finally, we have Chiliz, whose CHZ coin appears to have pumped on the news that the crypto project will merge with a South Korean crypto project called Clayton. We actually covered Clayton here on the main channel a while back. You'll understand why this is a fascinating announcement if you watched the video. Anyways, as you can see, this exciting news hasn't done much to increase Chili's price. This could be because Chiliz faces a lot of resistance to the upside. It's going to be interesting to see how the potential merger will affect Chili's tokenomics and price action. No doubt a topic for a future video. Now, if you want to keep track of the altcoins that are pumping the most and also where you can trade them, then be sure to check out the Coin Bureau Telegram channel using the link in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $50,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you want to pick up some snazzy crypto merch, the Coin Bureau merch store has it all.
You can find the link to that resource and many others in the description below.
Thank you so much for watching, and we'll see you in next week's episode.